Toulouse. He works in industrial organization and game theory. Let's see, you're also vice president of the Benelux Association for Energy Economics. From my personal experience, they have the best luncheons with the best food. And I don't know whether you get the thanks for that or not, but at any rate, be sure to go to one of their meetings. Natalia, don't go too far because you're going to be the opponent. So we will have approximately a half hour for the talk, 5 minutes for Natalia, and hopefully some discussion before we head off to lunch for Churchill. Before we go to lunch, do we need to provide any further information? Will lunch at Churchill be in the main room or in the smaller? Main room. We'll be up in the main room, and we have a little ticket that you can just wave at the cashier. Okay, Bert.
Okay, so I would first start with thanking the organizers for having me. So it's nice to be in Cambridge, as long as it's still feasible with the EU. Or I guess the hassle was lower, so switching or travel cost might increase, although
it's
there might
not
be
just experience.
Yes, and then the second thing, I would like to downplay expectations because there is no paper. This is all very recent, very young work. So maybe I'm going to benefit more from your comments than you are going to benefit from my talk. And I also have to say that Natalia did not receive any paper and that she received things quite late. So she's still going to ask nice questions, but she has to work with what she has. So what's my goal? So I'm going to look at investing in inflexible generation capacity. And basically, you have heard the story a bit before already that we have a lot of renewable energies that's going into the system. And the question that was already addressed this morning is whether an energy-only market is going to provide the right incentives for investments and also investment in flexibility. You have to deal with this fluctuating supply of renewable energy sources. And you could think, you might have different types of operators in the market, like storage operators. You might have demand response, and then you might also have some thermal generation that needs to adjust its production. So what I will do is mainly focus on this part. Let's say, how do you reward those thermal generators in ramping up and ramping down supply? So there's this policy debate that says, okay, energy-only market, there might be some issues, there might be no issues. And the question is, should we create also long-term markets? Should we create long-term markets for capacity? We have some energy price, we have capacity prices. Maybe we also need some flexibility prices. So that's sort of the debate that we might see arriving. And so there might be multiple market failures in the market. So we could have missing long-term hedging markets. It might be some financial risk that firms are facing if they're investing. There's a sort of fluctuating spot price. It's difficult to get financing. So that was also already mentioned this morning. There might be market power at investment stage. We might not get full entry. Maybe we want to subsidize entry. And there could also be inefficiencies in the spot price. So typically this is the case where there are price caps in the market, or where the government might intervene and might sort of firms might be afraid of increasing prices, like we just heard also with Natalia's talk, that maybe the government might want to regulate prices down for wind energy, and there might be some implicit price cap in the market. So what I want to do in the talk is to look a bit more into the spot market. So I'm not going to look at financial hedging, market power, and I'm only going to see, okay, is there something happening in the spot market with respect to flexibility? How is this being priced? And might this sort of have spillovers to the investment stage? So that's sort of the goal. I'm not sure that I will fully reach this. So you want to see how the short-term market design is going to affect long-term investments. And the short-term market, what I'm going to do is I'm going to look at two extreme versions. So one is the European market design, and the other one is going to be the US market design. So I will have a slide where I go a little bit further on that. So that's how you organize like the detailed day-ahead market. And I'm going to look at thermal generation, and the thermal generation is going to have some adjustment costs. So there's a startup cost. It can If it doesn't produce 1 hour, in the next hour it has to start up, there's an extra cost of starting up the power plant. Yeah, so that's sort of the extra part in this paper or in this presentation, that this thermal generation cannot just ramp up and ramp down its production, but each time there's an additional cost for starting up or shutting down. And I also assume that the power plant is either on or off, so it cannot sort of do some intermediate production levels. And then I would like to look at this kind of model. So as I already suggested, so it have no market power, no risk aversion, so they're all risk neutral, there's no storage, and there's also no investment in demand response. So it's going to be a very straightforward, simple model. So I'm going to look at two extreme versions of market design. So I'm going to look first at the US market. And in the US market, you basically have one complex auction. And this auction is going to clear different markets in different time periods. So the firms are going to submit all the relevant information to the system operator or the auctioneer, and it's going to say, okay, these are my fuel costs, those are my startup costs, and typically they have like a 2-page, 3-page set of all kind of system constraints, all kind of costs that the firm has. And then the auctioneer is going to collect all those bids from all the people in the market, and then it's going to run a big optimization program, minimizing overall system costs given the demand that they have to satisfy. And then each firm basically gets back how they should schedule their firm, when they have to start up, how much they have to produce, and at which price they're going to be able to sell their energy. So this optimization program is going to give the quantities, but it's also going to say what kind of prices firms are going to get. So they're going typically to receive an energy price, which is sort of the reward for the variable cost, for the fuel costs and things like that. And then, if necessary, they might also receive an uplift payment. So this basically means if there are some startup costs that need to be refunded, they're going to receive an additional payment, and they say, okay, given that you had to start up, there's an additional cost involved. If you just get paid the energy price, this might not be enough to pay for the startup costs. So we are going to give you some lump sum payment that's not related to your energy output. And then typically those uplift payments, I mean, they have to be collected from consumers, but typically those papers are not very or those models are not very precise. So I think that most markets, it just comes in some way from a lump sum payment from consumers, but maybe have to read up more on what they're actually doing. But okay. So then we have the EU model, and the EU model is sort of a simpler, in some ways simpler market. So we have basically one auction for each hour. And firms are just going to submit a price bid for each period, then the market is going to clear. In each market separately, there's going to be clearing price and a clearing volume, and then as a firm you have to decide, you have to sort of follow this production that comes out of this auction. So there are no uplift payments, and basically the firm has to decide itself when it's going to schedule up and down. Yeah, so it receives, okay, in this hour you have to produce 100, the other hour you have to produce 0, so it basically means, okay, you have to shut down the power plant. If it's the opposite, you might have to start up the power plant, and you take that risk yourself as a firm. So that's sort of the two types of models I would like to compare. And I had some conjectures when I started with the paper, or with the presentation, I guess. So the US model I thought was going to be very efficient in the short run, because it's going to use all the information from all the firms. So this could lead to efficient production scheduling, because you know what the startup costs are and how they're going to interact with all other firms. This might lead to very good efficiency in the short run, but I was a bit worried that if you have this uplift payments, that this could lead to overinvestment, because those uplift payments might not reflect what consumers actually want to pay for their energy. And if those uplift payments would increase if you invest in inflexible generation, then maybe this could be an incentive to invest in very inflexible generation, because then you might end up with a lot of uplift payments because you're inflexible, and you might have to, you might need to be rewarded more in the future. I mean, there might also be some counterbalance that if you're inflexible, you're less likely to be called upon, so maybe you're also going to receive those uplift payments with a lower probability, so that's not completely clear. So then the EU model, you have some inefficiency in the short-term market, because all those firms are self-scheduling, so you could get the wrong schedule Firms might not start up at the right moment. And the existing capacity is going to be used inefficiently because they're not always running when they should be running, so this is probably going to lead to investments which are going to be below the social optimum. So that was my conjecture when I started with the paper, and yeah, we will try to see whether I can sort of shed some light on those conjectures. So what's going to be the model? So I'm going to have a model which is probably completely unrealistic for the market, but it's just showing, I hope, some of the intuition. And this is going to be a two-period market, so there's could be a day and night cycle, but I assume here that they are basically symmetric. It's elastic and stochastic demand with additive price shocks. You have a demand function for energy, for electricity in a certain period, and then there is an additional shock that leads to prices being higher in that period or prices being lower. Those two demand periods are symmetric, so basically I don't want to deal with how you bid in one or the other market, so this is to make everything simple. And then shocks, they're basically also symmetric, so it's basically the same distribution on shocks that's governing, let's say, demand in market 1 and demand in market 2. Okay, so that's on the demand side. Then if you look at the production side, so have a simple cost model. So basically you have production in market period 1 and production in period 2. And each power plant has a capacity of 1 unit, and it can be either on or off. So basically Q1 is going to be 0 or 1, depending on whether you're producing or not. There's a fuel cost or a variable cost, so that's basically if you're on, you incur the fuel cost. And then you have an adjustment cost, so the adjustment cost is just alpha whenever you have a different decision in Q1 and Q2. So if you're starting up or shutting down, I mean, it's sort of, you have to start up again the next period, let's say, if this is sort of night, day. So alpha is your additional cost of starting up or shutting down. And then you have some investment costs that you incur, and K of C is the investment cost that you're going to incur. And I have normalized it such that K represents the investment cost per time period per hour, so this is twice because we are calculating the cost for two hours. So if you look at this formula, I mean, okay, it's very simple, but what you see here is the opportunity cost for producing in period 1. So if you try to see how much does it now cost me to produce in period 1, so you have to incur the fuel cost, but then you also might have to start up, or you might not have to start up your power plant, and this is going to depend on what's happening in period 2. So if you're already producing in period 2, then if you are not going to produce in period 1, you might actually have to shut down the power plant, and this is going to lead to an extra cost, so your opportunity cost might actually be below your marginal cost. And if you're not producing in period 2 and you would have to produce in period 1, so then your opportunity cost might be higher than the marginal cost because you're going to incur this startup cost. Yeah. So what you see is that your opportunity cost, depending on what's happening in period 2, might be between C minus alpha and C plus alpha, and it's going to be somewhere in between those two, depending on what you know about period 2. Okay, so then I'm going to look at investment stage. So what I assume is that we have a continuum of technologies. So there's a continuum of technologies with different marginal costs. So you have a range of technologies from C lower bar to C upper bar. And K of C is the investment cost. So the C lower bar is basically base load production, and C upper bar is going to be the value of lost load. So that's the value of lost loads. That's basically sort of a trick that we use for people who are not really used in energy markets. So this is technology which comes at a zero capital cost, and then you can reduce the amount by just shutting down consumers, and the cost of shutting down consumers is the C upper bar, which is called the value of lost load. So that's sort of the extreme type of technology. So that's a peaker technology where you don't pay anything in the fixed cost, and you pay only marginal cost, and that's the C upper bar. So you don't have a technology above this, and then you have a pure baseload technology, C lower bar, and that's the cheapest technology that's available if you for sure can run all the time. Then that's going to be the lowest, the best technology that you can choose, which corresponds to some fixed cost investment. So for now, I make the assumption that all those technologies are going to have the same adjustment cost. So the adjustment cost alpha does not depend on the marginal cost, which is probably not what you would expect in practice. But I have some slides in the end where I try to see, okay, what can be done to alleviate this constraint or to relax this constraint. So then I look at the market equilibrium. So I'm going to have long-run equilibrium where I assume there are no entry barriers, so all the firms can enter. The risk-neutral firms, so there are and basically many potential firms that could enter with a certain technology C. And given that there are no entry barriers in risk-neutral firms, this would mean that there is a long-term zero expected profit for all the firms and for all the technologies. And then once all the firms have entered, we are going to see some aggregate market supply function, which is sort of representing the equilibrium merit order curve that you're going to get into the market. So we are basically interested, how does this merit order curve change if we change the market design in the spot market once we have free entry. And in the short run, so we also assume competitive bidding, so they're all very small firms. And so firms are basically price takes in the spot market, so not as in Natalia's model where they all do sort of different bidding. But this does not mean that they're naive, so they're not just going to bid equal to their marginal cost, but they're going to take into account their opportunity cost. So this means that if they know that they're likely not producing in the other period, that they might actually increase their opportunity cost. So they're small firms, but they are not. They're sort of they take into account their opportunity cost. So they're opportunistic, but small. Okay, how am I doing with time?
So we need to have lunch at 12:45. So
Okay.
you have to take 15 more minutes or 17 more minutes.
Yeah. Okay, so I need to
Sharply end at 35.
Okay, so I don't know if I have to speed up, but okay, so what I first want to do is to look at the short run and compare what's happening in those two markets. Then I would like to look at the generation mix, sort of a standard formula for how does the optimal generation mix look like, and then try to go to some example. So I first want to go to the one single firm. How is the one single firm going to react in both US and European market? And one single firm is basically going to see prices as being stochastic over a price distribution and then has to make its decisions. I think given the time issue, I will try to skip some of the formulas. So basically the firm is going to submit, in the US market, the firm is going to submit all its information to the auctioneer, and then the auctioneer is going to decide when the power plant should be running and when the power plant should not be running. And basically, if you have stochastic prices where P1 can sort of be distributed, P2 can be distributed, then this is going to be the production schedule that the auctioneer is going to put in place. Yes, so you're going to produce only in period 1, let's say, if the price in period 1 is high and the price in period 2 is low. If the price is high in both periods, you're going to produce in both periods. And then if the price P1 is low and price P2 is high, you're going to only to produce in period 2. And then here you have a region where you don't produce because sort of the sum of both prices are going to be too low. Yeah, and this auctioneer knows how the actual prices are going to be realized, so that the auctioneer can sort of take into account sort of calculating where is the boundary between producing and not producing in the market. Yeah, so that's sort of quite efficient. Okay, so now if you look at self-scheduling, so basically what you can do as a firm is basically submit a bid function in market 1, a bid function in market 2, and if the bid function is going to, if the price P1 is above your bid, then basically you're going to be scheduled on. If the price in market 1 is below your bid, then basically you're off, and this is going to be the same in both markets. So if everything is symmetric, so basically you might have a firm that's going to submit B1 and B2. And then in the market equilibrium, you will see some production outcomes. And then if the firm would bid B1 and B2, you would see that it's going to be producing here in the green area in both periods. And then in the orange areas, it's going to produce only one period. And then this red area means that it's not going to produce at all. Yeah, so given the fact that the firm can only have sort of information about the bid structure, you see that there is some loss of efficiency Yeah, because basically the production, you can only condition this on the realization of one price, but you cannot condition this on the price in the other period. Yeah, so if you compare this with the US system, the production decisions in whether you produce in period 1 depends on the prices that you're going to be charging that will be realized in period 2. Yeah, so you can sort of optimize on both time periods. In the European system, you basically cannot do this. And this leads to an inefficiency in the spot market. Yeah, and what you can also see is that those orange area, that's basically the moments where you're going to incur ramping costs. Yeah, so if there are ramping costs, you would try to minimize those orange areas. So basically, if you have a small marginal cost, the way how you can minimize those two areas is by bidding a bit below your marginal cost. Yeah, because then you're sort of reducing the size of those areas. If you have a high marginal cost, what you're going to do, you're going to bid above your marginal cost, because then you reduce the likelihood that you're going to incur those ramping costs. Yeah, so that's basically taking into account this opportunity cost. You're going to set the bid above your marginal cost, and this depends on the likelihood that you're going to be producing in the other market. Okay, so that's sort of what's happening in the short run. I had some other explanations there, but now I would like to see what's happening in the long run. And the long run equilibrium, basically I would like to start with this optimal generation mix formula, which is something that probably some of you already know. And I have sort of a new function, which is going to be the cumulative distribution function of marginal power plant with cost C, that this is going to be marginal in market I. Yes, this is, let's say, 80% of the time. Let's say if this would be 80%, then this would mean that this power plant or someone with a lower marginal cost would be the one which is producing the marginal power plant in this market. And if you have an optimal generation mix, then basically this condition has to be satisfied. Yeah, so you're going to invest in lowering your production costs. So that's the benefit of producing from lowering your production cost. This is the cost of, let's say, lowering your production cost, and there's benefits of lowering your production cost, and that depends on how often you're actually producing in the market. Yeah, so HC minus, it should be the other way around, I guess. 1 minus HC is, maybe some minus sign here, yeah. So that's basically how likely a firm is going to be producing with a certain marginal cost. Yeah, so it's only producing if the marginal power plant has a marginal cost which is higher than you. Yeah, so that's basically how often you'll be producing in the market. Yeah, so this condition holds sort of in the standard textbook example if you think about optimal generation mix in the market, and this expression is also going to be valid in the models that we're going to look at here. So the only difficulty is sort of trying to specify how likely are you going to be, what's the distribution of the marginal power plant as a function of the marginal cost. So I had some extra slides where I tried to show that this is also holding, for instance, in the US market. So basically, yeah, it's the free entry condition where you take sort of the first order condition. So it basically means that the short run profit, the derivative of the short run profit with marginal cost should be equal to the investment cost, the slope of the investment costs. And by using the envelope theorem, you can basically show that if you change your cost, that this should be equal to how often you're actually producing. So that's going to be valid also in the US market. So what we can do now is to look for the long run equilibrium. So we have this optimal generation mix formula. That's sort of a formula that we just showed. That's quite intuitive. And then if we have a certain aggregate distribution function of the industry, and we assume optimal bidding behavior in the spot market, we can derive what's the likelihood of a certain firm to be marginal. And then if we combine those two expressions, so basically we have to invert this expression, we can find back what's going to be the optimal generation mix, or the equilibrium generation mix. Yeah, this I will probably also skip. So I will go straight to the example, because it's kind of nicer, I think. So what I'm going to do now is to sort of do this whole trick, and I'm going to use this for a simple example. So this is also not supposed to be realistic. So have certain technology function, which gives then a certain distribution for the marginal power plants. So 1 is my baseload technology, 6 is the marginal cost of my value of lost load. So these are not supposed to reflect actual numbers. Then there is a linear inverse demand function. There's a uniform distribution of my shocks. So the shocks, that's the price shocks. So it's going to be between 5 or 4.5 to 20 or so. So that's sort of the setup of the model. So then I'm going to look to the EU market design. So this is basically a price quantity graph. And the blue line is the aggregate capacity that's going to be invested in the market. And the red line is going to be the bid function that you're going to observe in the market. Yeah, so basically the firms here, they're going to bid below their marginal cost. And then because those are the baseline, they want to be sure that they're always inside the market. And as you remember, their opportunity cost is C minus alpha, because they were sure that they're always going to be in the market. So they're going to bid below their marginal cost, but there will always be someone else who's going to be the price setter. Yeah, so in the end, they're still going to make zero profit, because if you take expectations over, let's say, different demand realizations, you will get different prices, and they're still going to make zero profit. And then you see here the peakers, they're going to set price above marginal cost, because they will likely only be producing in one period, and in the other period it's going to be likely that the demand is lower, so they have to include this opportunity cost here into their bid function, so they include here the startup cost. So that's what basically is happening in the EU market. Yeah, so you see that firms sometimes sell below marginal cost, so that's basically risky. And firms need to make guesses about how the distribution is in the rest of the market. So when they're formulating their bids, they need to make some stochastic program, or solve some stochastic program where they try to see, okay, how likely am I going to be producing also in the other market, and then sort of include that in the bid. So this is kind of a risky strategy. So now if you look at the US market design, so basically we get a new set of investments. So this is going to be this blue line. And now we can no longer describe the prices that are going to occur in the market, because this no longer depends only on what's happening in this market, but also what's going to happen in the other market. So prices in any state can be somewhere between the upper red line and the lower red line, and this depends on whether the demand in the other market is high or low. Yeah, so it's going to be somewhere in between. Yeah, so if you're, and then we have free entry, so this firm is going to make zero profit, but this is going then to be depending on what kind of prices it's going to achieve. Okay, so now if we compare both markets, let's say what's the difference in investments. So investments differences are very small. So here the straight line is basically the European investment, or the aggregate investment, and the other line is what would happen under the US system. So, okay, it could be the parameters that it shows, but it seems that there are very small differences between those investment strategies. So it seems that based on this first simulation, it seems that the welfare effects in my setup for changes in investments are relatively small. Yeah, but if you would look at short-term price distortions, they might actually be quite large. Yeah, because if you look back here on the graph, the US system basically gives the right signals about prices, and it could be that prices have to be somewhere in this range to give the right signal to consumers. And in the European market, that's the wrong direction. The European market, there is always this markup independent about the realization of the relative demands. So this might mean that there is quite a big inefficiency in the pricing here, which could lead to quite big deadweight losses, while probably in the deadweight losses here about the wrong investments might be smaller. Okay, so I skipped some of the discussion, but I hope that the conclusions are still fine. to follow. So what we see here is a complex US auction allows for better intertemporal decisions in the short run. Bidding is going to require less information about market conditions because a firm knows maybe its own startup costs but doesn't know, let's say, the distribution of prices in the market and how other firms are going to act. It might be less risky for bidders because they're not sort of obliged to sell below marginal cost. They just can be bidding their startup costs. And the difference in the technology mix is limited, so it seems on the long run, at least in this model, differences are not that large. So I have assumed that there are very small firms, and what you can see if those firms are very small, that you don't need uplift payments. So there seems, if you have this continuum of small firms that all can produce 0 on 1, then actually you don't need the uplift payments. So these uplift payments, you only need them if you have, let's say, 1,000 megawatt going on and off, and you sort of change price distributions. But here, I still need to check this a little bit more, but it seems you don't need the uplift payments because they're actually like infinitely small, and you then you don't need those uplift payments. And I think that the US market achieves the welfare optimum because you don't have those, you don't need the uplift payments, so nothing really happens there. So if those results are true, this also means that this might be a benchmark for many of the US system where there's still some discussion about how should we design those uplift payments. At least it should be the case that if you make firms smaller, that you converge to something that we have here, where the uplift payments disappear, and then we sort of converge to something that might be welfare optimum. Yeah, so in practice, I also assume that demand shocks are uncorrelated, and that only in the European market firms can only bid in the day-ahead market. So both of those results are clearly not the case in practice. So demand might be correlated, and in the European market there are several parallel markets. You might have the day-ahead market, you might have the balancing market, you might have the reserve market, all kind of ancillary markets that might help firms to coordinate. So maybe I'm overestimating sort of the balancing cost that we might have in the European market, because there are mechanisms there for firms to learn about the state of the world. And yeah, so assuming that demand is uncorrelated, they're probably also overestimating sort of the costs of the startup costs. And then I assumed that adjustment cost is the same for all firms. I think we can weaken this in one direction. We want to make sure, okay, so what do we get from this? So basically monoticity. So basically means that base load is always going to run before peak load, and that we have all technologies being built in equilibrium. So if we drop this assumption that cost is the same, then we might actually lose the monoticity assumption, and we might also have technologies, not all the technologies which will be built in equilibrium. So this might become a bit of a tricky problem to track. And one step further is actually where also firms can build and invest in flexibility, so they could sort of pay capital in order to reduce the alpha, and then the capital cost would be a function of the marginal cost, but also in the parameter alpha. And this model would even more difficult to track. And my intuition, if you look at the simulation, is that price variation is going to be larger in the US market than in the European market, because you basically have prices fluctuating both for low demand and higher demand. So this, my feeling is that the US market is going to provide more incentives for firms to become flexible, because those prices are going to fluctuate more than in the European market. While in the European market you might actually invest in flexibility to avoid sort of this risk of being obliged to sell below cost. So there might be sort of some risk aversion reason why in the European market you want to invest in flexibility. Yeah, that was sort of an extra slide trying to say that it's difficult to endogenize flexibility. So I think the most interesting one is where the capital cost depends on flexibility and your marginal cost, but it seems this sort of becomes a multidimensional screening model, and that's difficult to solve. But yeah, maybe if someone has suggestions, I'm happy to take them. Okay, so
Okay.
okay.
I appreciate you sharing your thoughts about where you might go from this and so forth. That's very, very open and should stimulate discussion during lunch if we don't have time now. But Natalia, your nemesis has arrived.
Yeah, so Bert did a great job in providing comments on how the model should be extended. So I'm not going to go into the direction. I think he's looking into an issue which is extremely complex and yet extremely relevant. David told us that electricity is not just one thing called electrons. There are some power plants that provide clean energy, others that provide firm capacity, others that provide flexibility. And yet the issue is how should we be paying for all these services? Is an energy-only market the right solution to address all these different issues, or is it not? The issue why I believe flexibility had not yet entered into mainstream modeling is precisely because it's very complex. It implies bundling together different problems, so it becomes a dynamic problem. As Bert clearly showed, one thing is the marginal cost, and something very different is the opportunity cost, and the two things can differ in dynamic models, and therefore what we find is that even competitive firms, they are bidding at the opportunity cost, which depends on all the parameters that were included into his model. So it's very complex, and I think whatever progress you make, and you've already shown that you've made progress in that direction, is very welcome. Of course, as an IU economist, when I see your slide that you assume no market power, no risk neutrality, no storage, no demand response, this is where I feel tempted to say, add market power, add risk aversion, and so on and so forth, but I think that's not probably the right way to go until we know exactly whether the market is providing the right incentives if we assume away all those complexities in reality. But yet, some ideas came to my mind. So, for instance, in your model, what you find is that if you are bidding according to your opportunity cost, and your opportunity costs are steeper, sometimes you want to bid below marginal cost to incorporate the fact that you want to be reducing your adjustment cost to be up and ready for the second period, and yet you might want to be bidding above marginal cost at peak times. Those supply functions become steeper, and we know that with the steeper supply functions, there's more market power. This paper that I also referred to by Vives essentially shows that in these markets there might be a winner's course. So if I don't know exactly my cost, then at times when the market price is very high, probably it's because firms decided their costs, or they have information about their costs being higher in the future, so at that point they say, okay, if the market price is high, I'd rather offer very little to the market, whereas if the market price is low, that means that it's quite likely that my costs are going to be low as well, so I'd rather offer a lot of quantity to the market. So you find these steeper supply functions which are similar to the ones you find, and these type of supply functions reinforce market power. So that's one idea related to market power. Another idea related to risk aversion, and I think you mentioned that as well, though I'm not sure I follow precisely your prediction about price variation being larger in the US. If your supply functions are steeper, probably you're going to have more price variation than if your supply functions are going to be flatter, and therefore you're going to have more price volatility, which might also be affecting your investment incentives. But at the same time, there might be a greater role for demand response and storage that might be reducing the need for this adjustment cost. This is all to say, I don't want you to add all those ingredients into the model, but as an IO economist, I cannot prevent myself from thinking about all these ingredients that are present in practice, because this is where my question comes. If we were the policymakers, what should we make out of what we learn out of your model? Should we leave things as they are? Should we allow firms to make contingent bids, which in some markets is called complex bidding? That is, not only I submit a price per period, but rather I bundle, so I condition how much I offer into one market to what I dispatch in the other, for instance? Or should we do as we do it in the US? What do we learn out of your model for policymakers? Thank you so much.
Okay, thanks a lot. So I'm trying to remember everything you said. So I will start from the back. So me and Per, we are working on models about market power in interrelated markets like complex bits, and we try to see whether complex bits improve or reduce market power, and that's an ongoing project for I don't know, where's Per? I think for 3 years, 4 years.
Well, I would say, yeah, more than I would say at least 5. I would think.
Yeah. Okay. So it's not improving, not going that quickly, but so we're working on that, and I'm not sure that including the time period is going to help. I agree that sort of this steeper supply functions is going to lead to more market power, and also with Per we had some modeling where actually firms commit to become to have steeper supply functions. So also we find similar results. So it seems that everything sort of pushes firms to become more steeper, in their bid function. But it might also mean that for competition authorities, giving these results, it also becomes harder to identify market power. So if I would, without changing the model, would have to go, okay, what can you learn? Is that, okay, competition authorities, if you see something steep, it doesn't always mean market power, but it might just be opportunistic bidding by firms. And the other point that you mentioned was, let's say, the price volatility. So in the European market, volatility would be, let's say, your price demand functions moving around, and then what you get is, let's say, this red line, and you will see different kind of prices. So that would sort of give some volatility in prices. In the US market, those two red lines, that could be the prices that you get for low demand periods. Yes, so here you have, let's say, different realization of demand, and then depending what's happening in the other market, you might end up here at the lower bottom, or you might end up at a higher price. Yeah, so even for low demand, you might sort of have low price and high prices, and you would see, let's say, prices fluctuate for low demand depending on whether what's happening in the other market, whether prices are high and low. And you would see more observations here at a low price, because it's likely that the other market is going to be higher, while on the other side you're going to see more price observations above, because if demand is high, it's likely that on the other side the market is going to be low. So you will see, so it's not completely clear whether you see more or less variability. So it's probably if you would have a cloud, a distribution cloud, it's going to be a bit similar to the previous picture of Europe, but there will be some deviations around it. So maybe I just should do the simulation and calculate the variance. Okay. Did you say something? No. Okay.
So I'm hoping that we can get at least one question from the audience this morning. I haven't been very successful in disciplining the speakers.
I have a question.
Nemesis. So, Andy.
It's not a Nemesis question. It's a question about empirical evidence. Is there any empirical evidence that we have these markets that have operated like the US and other jurisdictions at the short run inefficiencies? Do we have empirical evidence for that? That one is more efficient than the other? I mean, you've got some numbers from your model, but it'd be nice to know the extent of these in real markets.
I mean, the question is, I don't even know how to start with it, because I mean, often people assume that they know all the cost data, and then by definition the US market would be efficient because they use all the information that's available.
I guess I'm asking how material are the differences. If the US market's efficient with the cost data, and you look at another market that uses the European model, can you kind of...
Yeah, I think the problem is that we might not have enough data about the European market, because many of those firms, they self-schedule, so you would need to know some of their startup costs, and then see how big of a mistake do they make in the end by scheduling the wrong power plant. So yeah, I guess you would need a lot of data from those firms and do sort of an alternative dispatch model, and then try to second guess the firms and say, yeah, I know better what you should have done, and this is sort of, and I think that's...
Schmuller did something like that a while back, maybe with Ranty, is that something he did?
He's here, but he's...
Ranty did something on Australia, or
I think he wasn't listening completely. But no, I think it would be nice to maybe even run an experiment, but I don't know if that's going to work. But
Oh, okay.
Again.
Yeah.
The obvious market to look at is the single electricity market of Ireland, because they have moved from a pool centrally dispatched to self-dispatch with the same plant, and they have a great deal of data. So it really would be interesting to now look before and after.
And perhaps you're already doing so, but don't want to tell us.
No, I would love to have the funds, the research assistance, the capability to have it done, but it's not something I could take on. But it's worth doing.
Okay. Well, I'd like to thank everybody who participated this morning.